Hey everyone, in this video I'm going to discuss other sources of income as well as other general deductions from net income for tax purposes. Just a reminder, and I haven't reminded you in a while, but this video is meant to be viewed after reading the appropriate and required chapters in the textbook. Just watching the video is probably not going to be enough to get you through any kind of exam, but hopefully it's going to set you up well in order to tackle the problems that we ask. Okay, here we go. Let's talk about the expected learning outcomes for part 1 of chapter 9. So hopefully, upon completion of the required readings, as well as watching the videos and doing the quizzes, etc., students should be able to identify other sources of income that are included in net income for tax purposes. Students should also be able to identify specific deductions from net income for tax purposes that can't be deducted against any other specific type of income. These are more general deductions, and we'll talk about where they fall into our overall schematic for net income for tax purposes very shortly. Ultimately, we want students to be able to determine the type and the amounts of moving expenses that are eligible for deduction from net income for tax purposes. Not all moving expenses are eligible, but a lot of them are. Hopefully, you'll be able to determine the type and the amounts of the child care expenses that are eligible deduction from net income for tax purposes. And I've got videos for both of these, moving and child care expenses, which we'll discuss in more detail. And hopefully you'll be able to understand the tax ramifications of and the application of spousal rollover provisions as well as attribution rules. There's a lot to do, a lot of it's straightforward, but there is a lot to get to, so here we go. We're going to cover chapter 9 of the text in 2 parts. In this first part, the topics that we're going to emphasize are specifically going to be Roman numeral 1, other sources of income, Roman numeral 2, other deductions, and then I want you to skip to Roman numeral 8, where we're going to talk about part D here, non-arm's length, the definitions of non-arm's length, as well as part E, which is specifically discussing property that's transferred to a spouse or a child. We will tackle other components of chapter 9, but not until the subsequent week. Always like to bring things back to our net income for tax purposes calculation and formula. So let's just point out where we are here. We've moved through most sources of income, and now we're focusing specifically on what's called other income, and I'll tell you exactly what types of income get included under that umbrella. I'm also going to come into this part now, where we're looking at any other allowable deductions. These deductions, as you can see by where they show up in our formula here, are going to be able to be deducted against all sources of income earned previous to this. So these will be able to be deducted against employment and business and property income, as well as any potential taxable capital gains. Okay, so when we talk about other sources of income, what types of income, what specific income are we talking about? Well, before I define the specific types, I'll tell you what it isn't. Other income is income that can't be classified as any of the types of income we've learned about so far. And as you'll recall, those types of income are employment income, business income, property income, and capital gains and losses. Those are the first 4 types of income. We are now looking at the 5th and final type of income, which is other income. Now that we know what other income isn't, let's talk specifically about what it is. There are a number of possible different sources of other income. I'll talk about the major ones here. Now the first one is scholarships, fellowships, and bursaries. While it is true that technically these are supposed to be included in income, they're not always taxable. They're actually subject to a lot of exemptions, and I'll talk about those in the next slide. I just want you to know that yes, in fact, they are other income. They're definitely not employment, business, property, etc. The next major source here is pension benefits. So if you work for an employer for a number of years, and over the course of those years you pay into a pension plan, ultimately when you decide to take that money out of the pension plan in retirement, that money isn't tax-free. It gets included in your income as other income. A number of other different pension plans, such as Old Age Security, the Canada Pension Plan, as well as employment insurance, those are also considered other income as well. When received, they must be included in income and will be taxed. RRSP and RRIF benefits. We're going to talk next week a lot about RRSPs, which are Registered Retirement Savings Plans, and RRIFs, which are Registered Retirement income funds. Again, we'll talk about those in extended detail next week, but if money is withdrawn from either one of these tax deferral savings programs, they are to be included in other income. And generally that happens upon retirement of a taxpayer. Well, they'll take these, they'll take these receipts out and they'll include them in their income at that time. Any workers' compensation that somebody receives, so for example, if you're injured on the job and you receive workers' compensation payments, that is not tax exempt. That is to be included in income, and it's not employment or business or anything else. It is quote unquote other income. Social assistance, if you happen to be down on your luck, or just at present unemployed and not able to find a job, if you're receiving social assistance is unfortunately taxed. However, I will let you know that there are subsequent tax credits for social assistance. So ultimately, if you are on welfare, you don't end up paying any tax on it, which is, I think, a good thing. Any research grants that you would have if you were applying for a research grant to do research into cancer research or saving the whales or something like that, that would generally be included in income, but they will see there are special rules surrounding that as well. You would be able to deduct any actual research expenses from that. Therefore, you usually don't end up with much left over. Spousal support payments is the final type of other income that I'll briefly touch on. I will bring this up a little bit later on, but this is the spousal support payment, meaning a payment that you receive if you've been divorced or separated from your spouse and you're receiving payments from them on a monthly basis. I'll talk about the specific requirements for that very shortly, but it must be included in your income, and yep, you're going to get taxed on it. In the last slide, I talked about other sources of income, and now I'm going to talk about some specific limitations on some of those sources of income. And the first one is scholarships. So basically, scholarships are technically taxable in the Income Tax Act, except they're not taxable if a student is actually enrolled full-time and is eligible for the education tax credit, in which case the entire scholarship is generally considered to be exempt. Now, if they're not enrolled full-time, only the first $500 is exempt on an annual basis. So any other amount in excess of $500 would be included in income. So the next source of income I want to talk about is research grants. So research grants, as I alluded to in the last slide, yeah, the total amount of the research grant that you receive in order to do some research is technically included in other income. However, you're allowed to deduct all related expenses to the research, and usually that eats up the vast majority of the income, sometimes more, which ends up in a net inclusion of almost nothing. And support payments from a former spouse, again, these are required to be included in income, but there's a couple of different caveats on that. Usually this applies. So generally these are taxable as long as the spousal support payments are a periodic payment, meaning they come once a month or twice a month or something along those lines. They can't just be one lump sum payment, and they have to be pursuant to a court order. So there has to be some sort of a judgment. A judge has to hand down an order saying, yes, in fact, these spousal support payments are required to be paid. And this is quite common. So the vast majority of spousal support payments are in fact included in the recipient spouse's income. So far, it looks like almost every type of receipt of any money of any kind is going to be taxable in Canada. Sometimes you don't even get money and you have to pay tax on it. So are there any types of income that Canadians can receive tax-free? And I'm happy to report that yes, in fact, there are. So I'm going to go through a list of those right now. And try and, if you can, as a taxpayer, maximize your forms of non-taxable income. The first one is going to be lottery winnings. If you win the lottery in Canada, you don't have to pay tax on that. No income inclusion whatsoever. Terrific. Go out there and win the lottery, you guys. Receipt of a gift. If I receive gifts, I'm generally not taxed on that. If somebody, a nice friend of mine, gives me $10,000, super. I don't have to include that in my income. Thanks, friend. What about an inheritance? So, my parents or grandparents have passed on and they've left me millions upon billions of dollars. Again, I don't have to pay tax on this. That's not to say there aren't tax ramifications upon death of a taxpayer, but generally somebody inheriting money is not subject to an income inclusion. Life insurance proceeds. If I unfortunately suffer through the death of a loved one and they have left me as the beneficiary of life insurance proceeds, in general, I do not have to include those in my income. Profits from betting or gambling. Okay, as long as your business is not a professional poker player, as long as you're just going and betting occasionally on the weekend for fun, any winnings that you take in are not actually taxable. So is this encouraging people to go out and gamble? I have no idea. For the most part, it's not going to be an issue because most people don't have gambling winnings. They have crippling, horrible losses. Uh, Additionally, some non-taxable receipts are the proceeds that one would receive from accident or disability, sickness, or some kind of income maintenance insurance policy. Now, the receipts are tax-free only if the employee themselves has paid all the premiums. If the employer has paid a component of the premiums, then some of the receipts are generally taxable. I'm not going to get into too much detail on that, but for the most part, as long as the employee's paid the premiums on some sort of disability insurance and they receive a bunch of premiums upon being disabled, those amounts are received tax-free and there's no income inclusion. That doesn't, I'm not trying to encourage people to go out and get, sick or get into an accident so that they can get tax-free income. You're still sick and you're still, injured. I'd encourage you not to, but thankfully there's no burden upon the taxpayer to include those types of receipts in their income. Okay. That's about it for other income inclusions. I now want to talk about other allowable deductions. Now, these deductions are deductions that can't be deducted against any specific type of income, meaning these aren't employment income deductions. They aren't business income deductions. They're deductible against a subtotal of all those types of income earned before we evaluate whether or not there are any losses from employment, losses from business, losses from property. Hopefully this will make sense. I'll show you the whole formula later on and how this fits in, but let's talk about some of these specific other general deductions. Now, before we do that, I want to point out, and it's very important, the deduction of these items cannot create a negative net income for tax purposes. For example, if I had $10,000 worth of income up to this point, a combination of business, property, employment, whatever, and I had $12,000 of moving expenses, I can only deduct expenses to the extent that I have income. So I could only deduct $10,000 worth of expenses, making my income equal to zero. Any additional deductions would not be deducted in the current year. There is no negative net income. So the major deductions that we're going to talk about are RRSP contributions. If you as a taxpayer make a contribution to a registered retirement savings plan, you can deduct that from income in the year that you make that contribution. I will get into great detail on that next week. Support payments paid to a former spouse. So we saw that receipts of spousal support were included in income. Payments of spousal support are deducted from net income in these other general deductions. So again, they must be periodic and they must be by virtue of a court order in order for you to make this deduction. Same criteria as were required for the inclusions of spousal support. There are also moving expenses. So when a taxpayer moves for a new job or to start a new business, there are eligible moving expenses that may be deducted from all sources of income. I've done a whole video on that. You can check that out by following the link here. Same thing for childcare expenses. If you are incurring childcare expenses, meaning expenses that you pay out in order for your child to be looked after while you are out earning income, some of those expenses may be deducted. Generally not all of them. There are some specific limitations. I get into all the detail on that in my Sweet Childcare Expenses video, which you can check out by clicking on the link right down here. As I alluded to previously, these other allowable deductions, which come into play right here, I've noted that the subtotal here must be positive or zero, meaning, okay, we've got some employment income, some business income, some property income, whatever. We add all those up. Then we're going to add in any excess of taxable capital gains over allowable capital losses. Presumably at this point we have some sort of a positive value. We can take these other deductions here, meaning your RRSP or your moving or your childcare deductions, only to the extent that we have some income from either here or a combination of both, but there has to be some level of income. And we can only deduct to the extent that we have that income, meaning we can reduce income to zero, but not any further. Hopefully that makes sense. There's one more topic in this chapter that I wanted to get into before moving on to part 2, and that's the tax-free transfer of property to spouses and a little bit of attribution. So I'm going to just touch on it here, and then I'll just do a whole video on it. So in general, when capital property is transferred from one taxpayer to another taxpayer, there are some tax consequences for that. Not always. We talked about some gifting, and that's a possibility. But I talked about the gift to the recipient. Usually the transferor incurs some kind of tax consequences. Now, the tax consequences are definitely going to vary based on the relationship of the transferor and the transferee. We're going to talk about some specific relationships. We'll talk about that shortly. So the tax implications can possibly include a deemed disposition of the property. So what that means is the property that you own is deemed to be disposed of upon giving it to somebody else or selling it to someone else potentially. This could result in a capital gain or possibly a capital loss. Tax implications can also include attribution of income that's earned on the property back to the transferring party. For example, I give my spouse a rental property. The income, the rental income that spouse earns is taxed in my hands because I probably transferred it in order to try and get out of paying tax on that rental income. Again, I'll get into this in the video. You can find the video here, and it talks about all the special rules that limit the tax consequences of transferring property to spouses. Check it out. That is the end of this video. In order to prepare yourself for exams, check out any related Chapter 9 textbook problems. You can always ask me questions about problems in the text. Just send me an email. I'll get back to you as soon as I humanly can. Check out the sample videos. The links are through this video, and you can also check them out on D2L. All the worksheet problems that I posted, I think there's only 3, but they're nice and comprehensive. Definitely do those worksheet problems. The worksheet problems are always very similar to what I ask on the exams, if you hadn't noticed, from that midterm. And then email me. Email me with questions. I usually get back to you right away. Unless I'm swamped with marking, I usually get back to people very, very quickly. Okay, everybody. Good luck. Hope to get some emails from y'all.